For new private market investors, evaluating startup tech companies can be daunting. It is important to understand that private investments carry a number of risks that should be described in investment documents. Investors should read all offering materials and risk factors before investing. This video should not be considered as investment or tax advice. In this video, we will cover the stages a startup company goes through to an exit. Understanding the stages of a startup is important to get a sense of how long your capital will be liquid before a liquidity event and what the potential value may look like at exit. The seed stage usually refers to the initial funding of a startup. Seed funding has historically been the domain of friends and family, but is now commonly regarded as the first institutional funding round for a startup. The majority of seed funding is invested in development resources and continuing to build out the company's initial product through the beta version. Once startups have achieved traction, usually in the form of user growth or revenue, they are primed to raise an institutional round from a traditional early stage or life cycle investor. The final early stage round, Series B companies typically have achieved product market fit by this stage and have strong user growth, if not revenue. Companies raise capital primarily for the purpose of investing in sales and marketing. Once a startup has reached a Series C funding, it is generally no longer considered an early stage company. Such companies continue to fund expansion through investment in sales and marketing. An accredited investor should conduct due diligence to determine if the appropriate team is in place to grow the business. By no means does this team need to be large, but they must have the prerequisite knowledge and experience to execute on a growth strategy. Late-stage companies at this point typically remain unprofitable and continue to raise capital to fund growth and ultimately achieve an exit, although some companies may exit before this stage. The last round of funding before an exit is often referred to as a pre-IPO round. In recent years, such rounds have become dominated by non-traditional startup investors like sovereign wealth funds, mutual funds, and hedge funds. This stage is often attractive for accredited investors because much of the unknown and how it relates to the business has been discovered. Successful venture-backed portfolio companies traditionally exit in one of two ways, either through a sale to a larger company or through an IPO. While IPOs tend to get more attention from the media, M&A transactions have been a more consistent form of exit for startups of all stages. Recent years have seen venture-backed companies remain private for longer due to the burdens associated with being a public company and the abundance of capital willing to invest in late-stage private financings. This has furthered the presence of non-traditional investors in late-stage rounds, as more of the value can be increasingly captured pre-IPO. Startup companies at different stages present different opportunities for accredited investors. Before investing, an investor should ask themselves what their goals are. Every company will carry a different degree of risk and return, and as such should be evaluated independently. At the bare minimum, an investor should vet the product, the founder, the market demand and feedback, the growth strategy, and the team that are in place to give his investment the highest odds of success. At Sebron Capital, our venture capital team carefully evaluates each startup company we invest in against a disciplined due diligence process. Accredited investors can learn more about our methodology at sebroncapital.com/investment process.